Hello students, welcome to my class. This is Professor Vincent Usaga, and this is the presentation of part 2 of chapter 6, Internal Control in a Financial Statement Audit. In part 1, we did talk about the definition of internal control and we elaborated on that definition. We also talked about the fact that internal control for auditors is a big deal because the second standard of field work requires the auditor to have a sufficient understanding of internal control in order for him to properly plan for the audit and also to determine the nature, timing, and extent of the work to be performed. The nature, what kind of work are we going to do, what kind of testing are we going to do, when are we going to do it, and to what extent are we going to perform that particular task. So then we talk about a lot of other things relative to internal control, and we left off at discussing the components of internal control. And we said that for an internal control system to be effective, the 5 components, or these 5 components, have to be in place. They have to be properly put in place and they have to be properly implemented. In part 1 of the presentation, we said that control environment is number 1 and is the most important. We also talked about that extensively, and we also talked about the entity risk assessment process. Now let's take a look at the information and communication. We indicated that to operate effectively, an entity needs to be able to identify, capture, and communicate financial information and non-financial information, for that matter, to internal and external users in a timely manner. So, what process does management have to put in place to make that happen? That is what information and communication is all about. What kind of general ledger, accounting, or software are we going to utilize? What kind of hardware and software are we going to put in place? So on and so forth. So, moving along, let's take a look at the control activities, the 4th component of internal control. We said that the control activities basically relates to the actions performed in implementing the internal control that is put in place. So, for example, segregation of duties. The person that is responsible for authorizing transactions should not be the person who should be in custody of the related assets. And the individual that is responsible for recording the transactions should also be different as well. So we talked about the importance of segregation of duties in our previous chapters. So management is responsible for putting proper controls in place in every different areas to make sure that, again, the 3 objectives of internal controls are met. So let's take a look at the 5th component, that is monitoring of controls. We said that it is important that the whole internal control system needs to be monitored on an ongoing basis. So the ongoing monitoring is necessary to ensure that all the components are properly working as designed. So management needs to put pieces in place to make sure that the monitoring is ongoing. So we just finished talking about the components of internal control. Let's take a look at this diagram depicting the relationship of the objectives of internal control to the 5 components of internal control. Remember, in part 1, we talked about the objective or the definition of internal control. We said that the board of directors and management and other personnel are responsible for putting internal control system in place in order to meet 3 objectives. Number 1, reliability of financial reporting. Number 2, effectiveness and efficiency of operations. And number 3, compliance with laws and regulations. So we talked about that extensively in part 1. Then we also talked about we just recently talked about the 5 components of internal control. So the question is, what is the relationship between these 5 components and the 3 objectives? In summary, if management put the 5 components in place properly and put them in place well and have them implemented properly, then The achievement of the three objectives, and including safeguarding of assets, obviously will be met. So that is the connection between the two of them. So let's take a look at the 5 components again. Control environment. Here are some relevant principles on control environment. I just want to stress one: the fact that the organization demonstrates a commitment to integrity and ethical issues is the responsibility of the board of directors and management. Like we indicated in part 1, the more management and board of directors takes internal control, the more seriously every other person in the organization will also take internal control. The entity risk assessment process. Here we are talking about the organization has to take into consideration both external and internal events or circumstances that might impede the company's ability to initiate, record, process financial data consistently with management financial statement assertions. And we said there that there are some circumstances and situations that may arise or that may bring about the business risk. And here on this slide we have several of them. Let me just go ahead and zero in on only one of them. Take a look at the new accounting pronouncement. How does that situation bring about business risk? If a company is in an industry that have to deal with a complex new accounting pronouncement, the question is, as an auditor, the question is, what did management put in place to make sure that the individuals that are responsible for implementing these new pronouncement or accounting rules actually have a good understanding of these accounting rules and actually play them well? So if management is not doing anything about it, the staff are not being trained, and the staff don't even understand, or perhaps sometimes they are not even aware of the new accounting pronouncement. As far as the auditor is concerned, the likelihood that the financial statements are going to be reliable, complete, and accurate obviously is being compromised if the individuals that are responsible for understanding the accounting rules and actually complying with the rules in preparing the financial statements don't know what is going on. So that would be a situation that can bring about a business risk in terms of impeding the company's ability to initiate, record financial data consistently with management assertions. So additional principles relative to the risk assessment. Let's take a look at control activities. Like we indicated, control activities deals with the actions that have to be carried out in order to implement the internal controls. Moving along, information and communications. We also talk about that. Those are things management put in place to make sure that transactions are properly recorded and communicated, so on as to different users, so on and so forth. Let's take a look at the monitoring of controls. We also talked about that. We said that it is important that management put things in place for an ongoing monitoring of the whole internal control. Now, let's take a look at planning and audit strategy. Now, in chapter 4, we talk about the importance we talk about the risk, the audit risk model as a way of assessing audit risk. We also use the audit risk model as a planning tool. Here we are zeroing in on the control risk component of the audit risk model. Of course, we said accounts audit risk is equal to inherent risk multiplied by control risk multiplied by detection risk. Again, our focus here is the control risk. So now here we are assessing, the auditor is assessing whether the controls in place are adequate to prevent or detect situations that will result in the financial statements being materially misstated. So, moving along, let's take a look at the planning and audit strategy. This is very important, okay? Here, this flowchart helps us to talk about consideration of internal control in relationship to substantive procedure or detailed testing. So, the first question here is, The first issue here is the auditor needs to have an understanding of the design and implementation of the internal control. Thereafter, number 2, the auditor needs to document his understanding of the internal control. Then the question is, does the auditor intend to rely on those controls? If the answer is no, then the auditor needs to set a control risk at the maximum, meaning the maximum, and we are going to talk more about that eventually. Then the auditor will adopt the substantive strategy. There are different situations whereby the auditor will set the control risk at the maximum. One of them will be the controls are worthless, they are not working, they are not properly designed. Now, on the other hand, if the auditors intend to rely on the controls, then the auditor needs to use the reliance strategy, meaning the auditors plan to rely on those controls to prevent or detect situations that would result in the financial statements being materially misstated. Therefore, the auditor has to do a little bit more work. So take a look at the right side of the diagram. Number 1, then the auditor needs to plan and actually test those controls. If he's relying on those controls, then he needs to test them to see whether they're actually working as designed. Then number 2, then the auditor needs to set control risk based control risk based on the test of controls. Now the question is, does the achieved level of control risk support the planned level of control risk? If the answer is yes, then the auditors need to document the level of control risk and conduct or perform the detailed test as planned. Now, if that is not the case, then the auditor have to revise the plan level of substantive procedures, okay, and then conduct or perform the substantive procedures. So that will be the conclusion of part 2 of this presentation.